This is the negative yielding bond spectrum in the world, but it's also the gold laid on top of it as well. As you look at this spectrum of negative yielding debt and this reach into gold, do you think the two are correlated? My last guest corrected me and said no.
Well, look, I think they are to some degree. What you tend to find is in a low yield environment when interest rates are low, which we are generally globally, then gold tends to do well. There's another couple of factors in there. It's a confluence of factors that's really leading to that gold price. We've seen a lot of inflows into the likes of ETFs. There's stories around about some physical shortages in the gold market, which may be contributing to that as well. Plus, of course, geopolitical tensions. We're going to talk about a few of them today, I'm sure. We've got more overnight with what we've seen in Iran, and that also contributes to that investment psyche that says invest into gold as a safe haven. So I think those factors, when you pull them all together, are really resulting in that gold price.
On the geopolitical tensions that you've mentioned there, Colin, as we were saying at the start, we're looking ahead to the G20. What sort of credit trades would you be putting on around the trade story?
Well, I think when you look at credit and how it reacts in this environment around geopolitics, it tends to be viewed as something that does well, or certainly bonds do well when there are some geopolitical tensions. There's a flight to quality in the likes of US Treasuries. What we know about the geopolitical tensions, whether it's trades and tariffs discussions, is that it has an impact on growth. And as Gina said, that can have certainly a flow through to the equity market, but also for credit. What it means really is that you have this reach for yield as essentially people think about what do we do in this low growth environment. Central banks come together and they reduce policy rates. As a result of that, people say, well, we need yield. Is it in the equity market? Is it in the credit market? And geopolitics really enhance that because there's a concern that these rates will stay low for longer.
Colin, can we just take that forward into the BBB space? We put this into the GTV library. This reach for yield, that is the theme of what we're all talking about. BBB versus BB bonds. The spread there is just, what, 0.57? That's the narrowest since 2007. And there's a warning from Guggenheim. They say that BBB rated still risk being downgraded. You share that view? And is this a little bit too squeezed, this spread, or into a cutting environment? Does it go further? Does it go lower?
I think in a cutting environment when rates are low globally, this continues. There's a hunt for yield. We know that. We've talked about negatively yielding debt. There is a concern about the size of the BBB market. There's a concern about how much might get downgraded. But actually, if you look at what's happened in the last 12 months, there's been more upgrades than downgrades. So that rolling default move has been more positive than negative. So I think people are feeling fairly bullish about that. If you look at recent default numbers coming through, both globally, but especially in Europe, it's extremely low. We're below the long-term trends, and that's giving people confidence to go into the high-yield market. When there are no yields around, or when there's very little yield around globally, that's very much encouraged. And people look at European high yield and say, well, 3.5% is not a lot. But when you look at deposit rates are negative, potentially going more negative, then actually that's not surprising that people want to reach for that yield and say 3.5% is enough in this environment.